Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. This week, I'm joined by Neena Mishra, Zacks Director of ETF Research and the editor of the ETF Investor newsletter here at Zacks, as well as the host of her own podcast called the ETF Spotlight. She basically has everything covered on ETFs all across the board. And so I love having her on the podcast so we can discuss what's going on in the world of ETFs, because something always is, and it's always kind of fun and interesting. And especially this year with the market being down, where are people putting their money in the ETF world now? Where are the inflows going? Maybe some of the outflows. So Neena, welcome to the show.
Hi, Tracey. Thanks for having me on.
Yeah. So you're back to discuss one of our favorite topics. So maybe we should just lead off with that, is Cathie Wood and ARK, of course, ARK Innovation. And she's still in the news. I keep seeing her on the news. She's still giving her webinars, her monthly updates. You can tune into those. You don't even have to be an ARK investor. You can just sign up for their emails and go over there. She's still being completely transparent about what she's doing with her funds. And but the funds, especially the flagship, is still having difficulty here this year. So I know when we've talked about Cathie and ARK in the past, and we've done so many times, we were kind of wondering when or if money would flow out of those funds. It was still flowing in, I think, the last time we talked about her, even though the fund was down. But I'm kind of curious, what's happening with ARKK now? That's the flagship fund, and it's now down 61% year to date. Tesla still its largest holding, about 10% of the portfolio, and I know she bought some more Tesla shares recently. So what is happening? Are people staying loyal to Cathie here in the end of 2022?
Yeah, it's always very interesting to talk about ARK and Cathie.
Yeah.
And it seems that Cathie remains very popular. And I admire her conviction in her strategies, her belief in disruptive innovation. But it seems just not the right time to invest in disruptive innovation.
Yeah.
But what is surprising is that ARKK, the flagship fund, continues to gather assets, though it has been a bit bumpy. It did lose, it had net outflows in August, but then when, we saw that minor bounce in high growth stocks in summer, that brief summer rally, people thought maybe the worst is over. And the ARK Innovation Fund, ARKK, that took in just about $500 million in September, and it has gathered almost $1.4 billion year to date, which is very, very surprising given its performance. And what is interesting is that other ETFs, her space ETF, her fintech ETF, autonomous technology and robotics ETF, next generation internet ETF, genomic revolution ETF, all those ETFs have lost assets this year. So I think the flagship fund, the ARKK ETF, that is treated as investors believe that this is kind of a benchmark for disruptive innovation. So instead of investing in other funds within the ARK family, they are now focusing just on this particular ETF. And this trades a lot. This has excellent trading volumes. So this is used more by traders and who want to bet on disruptive innovation. So that is the reason why probably investors who believe in disruptive innovation continue to put money in this ETF. There are some other interesting developments also within the ARK ETF family. They named a chief futurist, Brett Winton, who was the former director of research. He was named as chief futurist, because there was some criticism about Cathie being the star power at ARK and ARK not having any succession plans. So probably he's now the successor, seen as a one of the probably heir apparent of ARK. Investment, and they also named portfolio manager Will Scherer. He was named as portfolio manager of 2 index funds. So all actively managed funds, Cathie is the portfolio manager, but the 2 index funds which are not really popular, the Israel Innovative Technology ETF, IZRL, and 3D Printing ETF, PRNT. These are really smaller, 180 million in assets in these 2 funds. So they have a new portfolio manager for these 2 ETFs, which is not significant because these are basically index rate tracking ETFs. And they also closed one ETF. That was actually just after a few months of its launch. They closed their ARK Transparency ETF, which had sort of ESG tilt, and it was an index tracking ETF investing in most transparent company. So that was closed in July within a few months of its launch. So there's a lot going on within ARK. And as you mentioned, Cathie remains popular. She's very often on CNBC and Bloomberg, and she continues to talk about her conviction and disruptive innovation and how wrong investors are to bet against those companies, and how now she's talking about the Fed also, that the Fed is wrong in being so aggressive about rate hikes and missing signs of deflationary pressures.
Yeah, she's been all over the place. I wonder if the reason that money is not flowing out in the same rate with ARKK like it is with some of the other ETFs that she manages is because ARKK is the oldest of the ETFs, right? It's the original one. And I'm just wondering if, a lot of investors are sticking with her because they've been in it longer than the others. So their cost basis might be a lot lower still, even though I know all that money flowed in at the end of 2020 into 2021. So some of them might have already jumped ship, but I'm just curious, wondering if because of the longevity of it, some people might be sticking around a little longer in that one.
So there are some other ETFs also which launched at the same time, but this is the flagship ETF, and in one instrument you can get exposure to all her disruptive innovation strategies. Yeah. So that is the reason why it is very popular with investors. So instead of trying to decide whether you want to bet on genomics or robotics, you buy this ETF and you get exposure to all those strategies. And plus it has excellent trading liquidity. So for investors who want to jump in and jump out of disruptive innovations stocks, this provides that easy vehicle. So that is one of the reasons, and people are sticking with her because this is her flagship fund. And it remains to be seen how long that can continue, because we did, as I mentioned, we did see outflows in August, but in September, investors came back again to ARK funds. But if the performance continues to suffer and she is not going to change her strategy, it seems she will continue to bet on those high growth, highly speculative stocks. It remains to be seen whether they will continue to suffer in the rising rate environment and whether they will continue to underperform, and whether investors are still going to put money in despite losing a lot of their money in her strategies.
Yeah, all these things are kind of up in the air, and we'll see what happens through the end of the year with the performance, obviously. And usually it's by that next year when a lot of investors start taking a look, or they are looking when they haven't been looking for a while, like in January and February of the next year. And then, we'll see what is happening there, what is to be seen, because just because it's at a new 52-week low here in October doesn't mean it's going to be by next January. So yeah, a lot of interesting stuff going on with the ARK. And as you mentioned, I do admire Cathie for sticking with her strategy. If you don't like the strategy, don't invest. That would be my advice. Like, a lot of people are complaining about it and, kind of angry about it, but no one says you have to be in that ETF. And if you don't agree with her about investing right now in these kind of innovation type companies, then don't. Like, that's my advice. So, yeah.
Exactly. I have never invested in Cathie's ETFs, and I have never betted against her. So I would not bet against her. Just stay away, because I don't believe this is the right time for disruptive innovation. It may have its time again, but maybe not in the current slowing growth and rising interest rate environment.
So does that mean you're in the short ARK? Neena, you're in that one. You are betting against her in the other fund.
No, I've never betted against her. So her the ETF that bets against Cathie, that was in fact one of the best performers earlier this year. It is the SARK ETF, and it quickly gathered assets too. Now the performance obviously suffered during summer when all those growth stocks rebounded, but that is a vehicle. If you want to bet against Cathie, that ETF is there. That is the fun part of the ETF industry. There's something for everyone. Right. And there's an ETF which provides twice exposure, leverage exposure to ARKK. So if you are a really big believer in Cathie's strategies, the TARK is also there.
TARK, is it TARK?
Yes.
That's the 2 times. And just SARK is the short, SARK.
Yes.
Okay. It's it doesn't even give, I wonder when this launched. It's not even giving me year-to-date total return on the TARK, maybe because I don't know. It's like not nothing, but it's got to be worse than hers, which is down 60%. So, that would be a tough one on that one to do. I'm just looking right now. Well, it does have big volume. I'm surprised.
Yeah.
The 2 times.
Wow. So this launched in May, and that the timing was perfect. I would say that this firm which launched both SARK and TARK, they have been very lucky with their timing, or maybe they are just very good with market timing. Probably they were just very lucky. So this launched in May, as I mentioned, and there was a brief rally in those stocks during summer. So obviously this ETF did pretty well during that time. I don't have let me look at the performance.
Looks like it's down 59% so far.
Yeah. So this, of course, the performance suffered when these stocks started coming down in later in September and October, but it had that brief rally after its launch.
Yeah. Now these are the types of ETFs that are mostly for traders, right? These 2-time, like, you're not like buying and holding this. Or are you?
So these are not inverse and leverage ETFs. They reset daily. So this is something which investors should remember, that these ETFs, inverse and leverage ETFs, because of the derivatives that they use and because of the daily reset, they are meant for very short-term trading or hedging against your portfolio. For example, now we have so many single stock ETFs, inverse and slightly leveraged single stock ETFs. So if you already own Tesla in your portfolio and there's an event, Tesla earnings announcement or something related to Tesla, and you feel that the stock is going to be very volatile for some time, then maybe you can hold that inverse Tesla ETF for a few days. It's just to hedge your portfolio. So similarly with the ETFs that bet against or provide twice exposure to Cathie's strategies. They are all very short-term trading strategies. And there's always something fun happening in the ETF world, as I mentioned. So there has been a recent filing for 2 ETFs that would provide long and short exposure to Jim Cramer's strategies,
Right.
long Jim,
L
LGM, LGM, and SGM. So those filings we saw recently, we don't know whether they are going to launch or not launch. But yeah, for people who believe in Cramer or who are big haters, there would be some strategies for them too.
Yeah, that's pretty cool. The Tesla ones, if I wanted like the Bear Tesla ETF, what's the ticker on that one?
It is TSLQ. So in fact, we saw a bunch of these single stock ETFs launched recently in the past 2-3 months since the SEC started approving these ETFs. These ETFs have been around in Europe for a long time, I think since 2018, and regulators in Europe and Canada, they are much more receptive to these kind of ideas. The SEC here has been more conservative, so they approved these ETFs only recently. And while approving these ETFs, the SEC also, the officials, they also issued warning to retail investors that these are not supposed to be used for longer term investing. These are very risky products. They should be used only by traders and people who understand them properly. So anyway, of all those ETFs, single stock ETFs that launched, only the one which provides inverse exposure to Tesla has seen some asset gathering. It has a little over 50 million in assets. And these are very expensive too. That is another thing investors should remember. So TSLQ, which provides inverse exposure to daily share performance of Tesla stock, that has an expense ratio of 1.15%. Now, the convenience, the advantage here is that many people do not have the exposure to other strategies of shorting stocks, like using options or using margin. So for them, this ETF provides a very convenient exposure. So if you want to, hedge your Tesla exposure for a few days, this is the vehicle you can look at. But this is again not meant for long-term holding. If you don't believe in your Tesla stock, just sell it, get out of it. But for short-term hedging, it makes sense.
Yeah. I didn't think about if you're confused about what options are, or you don't know how to short a stock or that kind of thing, like this provides a lot easier method to kind of do the same thing. Yeah. Mm-hmm. Mm-hmm. Okay, cool. Another area. Go ahead.
Yeah, sorry. I just wanted to say that there are many other similar ETFs which can provide you exposure against leverage exposure or inverse exposure to other popular stocks like Apple, Google, Microsoft, Amazon, even Pfizer. So they can be used for short-term hedging of your exposure or just for short-term betting against those stocks if you are a sophisticated investor and if you're watching your portfolio and market movements on a daily, hourly basis. These are not buy and hold products.
Right. That's always good to mention on there. Yeah. I see they have pretty good trading volumes, at least the Tesla ones.
Yes.
So, people are definitely using them as trading vehicles, which is what they are designed to do. So that's good.
Yes. And Tesla and Elon Musk, people either love them or hate them. So it's not surprising that the inverse Tesla ETF has seen most interest out of all the funds that they launch.
Yeah. Interesting. Okay, so another area that I wanted to talk about today on the podcast is the dividend ETF area. And I'm not sure we ever have talked about dividend ETFs on the podcast before when you've been on, but that kind of tells you maybe there is a trend in them, or it just tells you that the Twitter algorithm is sending me a lot of people who are tweeting about the dividend ETFs, because I seem to see like once a day people talking about them, and especially the Schwab US Dividend Equity ETF. The ticker is SCHD. And that one I see mentioned all the time. I had to look it up to find out what was going on, like with it. Well, like, what does it do? It's 100 stocks, all large caps. Expense ratio is pretty low at 0.06%. The yield is 3.4%, which is probably why everybody's talking about it, because that's pretty juicy. And it holds a lot of the big caps that pay big dividends. So, like in the top 10 is Merck, Home Depot, Texas Instruments, Broadcom, Amgen, Pepsi, BlackRock, Pfizer, Cisco, and Verizon. So anyone interested in dividends knows those names, because they are all paying out pretty nice yields. PE is just 14 times, so it's pretty cheap, but it is down 16% so far year to date. But those dividend investors, Neena, seem to like, they get all excited as it continues to go lower, because the yields goes up and it just gets cheaper. So they are like, I'm buying another share of the SCHD today. So what is going on with these dividend ETFs? Is money flowing into there, or is it just the smaller, like niche group of dividend investors who are kind of having fun right now?
Yeah, so dividend ETFs have been really popular with the investors this year. And the top gainer is SCHD, which you mentioned. You see a lot of mention on Twitter because it is the top asset gatherer this year. And as you said, that it is down about 14% year to date, but if you look at the comparative performance compared to the S&P 500 or the Nasdaq index, the performance is much better. So as far as dividends are concerned, there are two popular strategies for investing in dividend stocks and ETFs. One is the dividend growth strategy, which basically holds stocks that have been consistently raising their dividends for the past many years, like dividend aristocrats that have been raising their dividend for 25 years. There are many other dividend growth ETFs that look at stocks that have been raising their dividends for at least 10 years. So those companies are high quality companies, and those funds have a lot of exposure to technology stocks as well. So in the past few years, these ETFs were very popular with the investors because technology stocks did well. These were high quality companies, so you were getting dividends which were not very high, but at the same time, very good performance as well. But this year in particular, the other strategy, which is investing in high dividend yielding stocks, those strategies have been quite popular this year. And that is because they have a lot of exposure to defensive areas of the market that have delivered better performance than technology. And they also have a lot of exposure to energy stocks, and we know that oil stocks have done pretty well this year. So the ETF, like the iShares Core High Dividend ETF, the ticker symbol is HDV, that is down just about 4% this year. So that has also been quite popular, in addition to SCHD. Now, as far as SCHD is concerned, this provides kind of the best of both worlds. So you look, the fund looks at, not the fund, the index that it tracks. It looks at the sustainability of the payouts. It uses some fundamental screens like cash flow to debt ratio, dividend yield, ROE, dividend growth rate, etc. And and it holds companies that have a 10-year history of paying dividends, and those are all high yield companies, 100 high yield stocks. So you get the combination of high yield plus sustainability, and at a very low cost, just 6 basis points expense ratio. And in full disclosure, I do own this ETF in the ETF investor portfolio as well. And this has almost 37 billion in assets now. So a huge, huge ETF, very popular with a lot of inflows this year.
Okay. I think the SCHD is also in the dividend investor portfolio here at Zacks too. I want to say it's in there, but maybe I'm wrong on that one. But it should be. If it's not in there, it should be in there. Yeah, like it's pretty interesting to see like some of these, really good yields that you can get on these funds now. And some of them are outperforming what the S&P 500 and certainly the NASDAQ is doing. So why not? Yeah, I'm kind of liking getting income myself this year. So yeah, it's a good place to be. So speaking of energy, let's switch over to that real quick here. What's going on in the energy space? I know we've talked in the past about how there's never any new energy ETFs and that kind of thing, but I heard money was rotating out of the energy ETFs in September. And so I'm just kind of wondering if those are still out of favor or what is going on, because it still is the best performing sector for this year in 2022 again. So it is kind of surprising to hear that money might be coming out of it.
So as you mentioned, energy is the best performing sector year to date. It is the only sector in the green year to date, also the only sector in the green in the past 6 months, 3 months, and let me see, in the past 1 month, it is down slightly or almost flat. So energy is very interesting. There are times when a lot of money flows into energy ETFs. Investors chase performance and, they start buying funds like Gush, the leverage funds like Gush, NRGU, XL, EVDE. But when the performance suffers, and we saw that there were some months in summer when oil prices went down because there was so much concern about global economic growth slowdown, particularly demand slowdown in China. So oil prices went down and people left energy ETFs. So we see that investors come in and they book their profits and then they again leave energy ETFs. So they have seen asset gathering this year, but they are not on the top of the leaderboard despite energy's excellent performance. And one of the reasons is that because energy underperformed for the past so many years, so many investors who invested in oil maybe 3-4 years back, 5 years back, and they lost so much money. So now they don't have the kind of patience required with investing. So probably they invest for some time, and once they see their fund is up like 10%, 20% within a short time frame, within a few weeks, then they exit too. Now, as far as you mentioned that there is no new energy ETF, so there is one now.
Oh, so there is, yay.
So this firm, the anti-woke firm, it is known as the anti-woke firm, anti-ESG firm, STRV Capital Management. They launched the STRV US Energy ETF, ticker symbol is DRLL, and that launched in August and has already gathered about $330 billion in assets so far. So this is a pretty successful launch. So this ETF basically it says that these top 3 asset managers, BlackRock, Vanguard, and State Street, they have been telling these oil companies, the energy companies, to not invest in drilling, instead return capital to shareholders in the form of dividends and share buybacks. So that is the reason why the U.S. energy industry has suffered and oil prices are going up. And they basically say that most investors do not want politics to be mixed there with their investing, and they may not even believe in those ESG principles, but these big three are enforcing those ESG strategies on companies. So this company says that we will tell U.S. oil companies to drill more and invest more in drilling, pump out more oil and gas. And the CEO, he is very often on television talking about anti-ESG strategies and his belief in excellence capitalism. He writes frequently in the Wall Street Journal. He's quite popular. So that is one of the reasons why the CTF has quickly gathered a lot of business.
Yeah.
So
Yeah,
if you believe that, these asset managers were too tough on the U.S. Energy industry, and you want the U.S. energy industry to thrive and survive, then maybe you can look at DRLL. They launched two more. The drill was their first ETF, and then they launched two more ETFs. The first, the STRV ETF, that provides exposure, very similar exposure to the S&P 500 index, and it has a very low expense ratio of, I think it is just about 5 basis points expense ratio. And they basically say that we will use your money to tell companies to focus just on excellence, focus just on profits, not on ESG principles or anything else. And they also launched a CHIP ETF just a few days back. So those are the three options available to you if you believe that ESG had gone too far when we were really not ready for the energy transition.
Wow. Yeah, that's interesting. I looked up the drill one, and the two biggest holdings, not surprising, are Exxon and Chevron. Exxon's 21%. Chevron is about 16%. And then you have Conoco at 7.5%. But it also includes a mix of types of energy companies, including on the service side, because Schlumberger is in the top 10, and on the refining side, Valero is in the top 10. So you're not just getting the producers or the explorers and producers, the E&Ps. You're getting a mix here with the drill. So if you're interested, that's, go check it out and make sure you know what you're buying there, because you are. So
this provides a very market cap exposure like other big energy ETFs. It's very, very similar to IYE and has a similar expense ratio too. So obviously it is top heavy in Chevron and Exxon. Yeah. The only difference is that they will use their money, their shareholder voting power to encourage these companies to drill more and just prioritize profits and not ESG principles.
Yeah. Okay. Well, there is certainly a lot going on, as we said. And I know there's some more interesting launches still to come. So, maybe in a couple months we can talk about them and see what's happening as we get towards the end of the year with some of these more trendy launches that are out there, and what's happening with some of these recent ones, as well as ARK. We're going to have to check in on Cathie again at the end of the year. But let me recap a lot of the tickers here, because we did talk about a lot of ETFs on the show today. So, of course, there was ARK Innovation, ARKK. If you want to short it, it's SARK. And the 2-time long is TARK, TARK. Then we talked about the dividends, and we had the Schwab dividend is SCHD. That's the one that's taken the most assets in year to date. Then we had that core dividend, which is HD as in David, V as in Victor, HDV. Then we talked about the energies, and we had the new one, Drill, DRLL is the ticker for that one. And she mentioned the STRV 500 ETF, which is STRV. That's not energy, but that's their other ETF. And then she also mentioned one of the other older ETFs you can be in, which is the iShares US Energy ETF, which is IYE. IYE is that one. So I don't think we have any tickers on the Jim Cramer ones. Oh, no, you did say it. It's LJIM and SJIM for the short. But those haven't launched yet, so you're going to have to wait. But if you're listening to this a little bit later in 2022, those are probably out there. So have at it, have fun. Jim should feel flattered that he's got some ETFs planned against him now, because a lot of people have had Twitter accounts that are like short Jim Cramer accounts, and what stocks, he mentions that you should be shorting and all that fun stuff. So I'm sure he's taking it in the fun category as well, that is. And heck, maybe a lot of people will be the long side and not the short side for the Jim Cramer ETFs. But these are the signs of the times. There are always niches out there in ETFs, and Neena's always bringing them to us here on this show and on her own on ETF Spotlight. Be sure to check out that podcast. You can get it same places you can get this podcast. You can get it on Apple Podcasts. You can get it on Amazon Music and on Spotify, but make sure you're getting our podcast somewhere. And I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.